Before watching the video, don't forget to subscribe the channel and enable bell notification to never miss an update from us.
Hello friends, welcome to Entri. I am Mirzad Shambeg, your quant educator, and today I am going to discuss something very important from your banking terminology. As you can clearly see my topic, it is all about financial markets in India, and today we are going to discuss money market. What are the money markets and what are their types? So we will deal with everything in this video, and it is very important. Why it is very important? Because it can be asked in your interview as well as in your banking awareness question paper. Okay, so let's move on and let's see what the financial markets in India are like. We are basically going to discuss about money market. What is the money market? Let me elaborate you first. Okay, money market is an important term and you should know about it. Let me take the highlighter. As you can see, the money market is one of the two main segments of financial market. It performs the same function of mobilizing funds in the economy. That means it will help generate funds in the economy. However, the one main factor of the money market is that it exclusively trades in financial instruments. Okay, so all the financial instruments will be come into the money market, and its commodities will also be there that have a term less than 1 year. So its term will be less than 1 year. Okay, less than 1 year. All right. So the money market deals in low risk, generally unsecured short-term debt instrument. These instruments are a close substitute for cash since they are extremely liquid, that is can be converted to cash on short notice. So it can easily be converted into cash after giving a short notice. The maturity period of such instrument ranges anywhere from 1 day to 1 year. So it ranges from 1 day to 1 year. Okay, so there are lots of positives for money market and there are several types. Let's go ahead and let's read out the instruments of money market. There are several types of money market bills like treasury bills, commercial paper, commercial bill, call money, certificate of deposit. Okay, so let's go on and let's read about the instruments one by one. Treasury bill. What is a treasury bill? These are the money markets instrument issued by RBI. So basically it will be issued by RBI acting on the behalf of central government. These bills are issued when there is a shortage of fund. So when there will be any kind of shortage of fund, these bills can be issued. Or when the RBI wants to control cash liquidity. Okay, that means it's all about a monetary policy. Okay, if RBI wants to control the cash liquidity, where cash liquidity means whether the cash inflow is in excess in the market or in the dilute form in the market. So RBI will take steps like providing or issuing treasury bills to someone. The maturity of such bills, also known as zero coupon bonds, or is always 1 year or less than 1 year. Okay, so the maturity has to be between 1 year. They are highly liquid instruments and are very low risk. Why very low risk? Because the government of India has been, or the particular government will issue the treasury bill, so they have the security. Treasury bills are issued at a discount than the face value. Okay, so let's say that you have 100 rupee note. Its face value is what? 100 rupee, but treasury bill will be issued less than the face value. Okay, and are redeemed at par. The difference is the interest received by the holder. Okay, the only difference. You will say that how can we generate the benefit? Then you will be benefited with the interest, which in this case will be known as discount. So the interest terminology will be known as discount. Commercial paper. What is the commercial paper? Commercial paper is a promissory note. What is promissory note? Let's go ahead. It is a short-term uninsured debt instrument. Okay, These are generally issued by large companies. Okay, so lots of MNCs and all the companies, or you can say large companies, issued these commercial paper, and corporations in need of quick term loans. The funds, because lots of industries needed a quick term loan, so they approach the bank, and they can get any kind of loan within a short frame of time. The funds could be required for working capital needs or some seasonal changes to meet expenses. So let's say that this pandemic has arrived. That means lots of companies were in need of promissory note or a commercial paper or in a fund crunch. So they can use this promissory note, all right, to meet expenses of issues of shares, etc. Commercial papers have a maturity date between 15 days to 1 year. So from 15 days to 1 year, they will have the maturity date. They are also issued at a discount and redeemed at par, same as the treasury bill. They are highly liquid and easily transferable instrument in the money market. Okay, so these are the commercial paper which can be issued by large industries companies. Okay, commercial bill. A commercial bill is essential of a bill of exchange. In a credit sale, the seller will draw a bill of exchange. The buyer of the goods will accept such bill, and the bill becomes a trade bill, which is a marketable financial instrument. Okay, so that bill can be applied in the market, which can be called as marketable financial instrument. The seller can then go to his bank and get the bill discounted. Okay, so the seller can approach the bank, and its bill can get the discount. Here the bank will promise to pay the amount if the buyer is unable to do so. So bank took the guarantee. Bank is the guarantor. Alright. And this way the trade will become a commercial bill. Alright. The general term for such bills is 30, 60 or 90 days. So it could be up to 3 months. Alright, it is negotiable instrument and is also self-liquidating. So it is, I believe it is one of the most easy bills, or you can say most easy instrument of a money market. Call money. At times even banks may need help with maintaining their funds. Alright, because at some point because the lots of all the banks has to follow RBI guidelines. Okay, RBI guidelines. That means at some times they will find difficulty to follow these norms, and they might be short of some money. So what would they do? At such times they loan on other commercial banks. So they can take a loan from other commercial banks for a short term loan. Okay, that's known as call money. Such an instrument of the money market is known as call money. One important factor is that this interbank transaction has no maturity date. It is payable on demand. Mostly banks depend on call money to maintain their cash if liquidity ratio as per RBI guidelines. As I have told you, the rate of interest on call money is known as call rates. So the call rates can be decided between the banks. Certificate of deposits. These are money market instruments issued only by commercial bank. So specifically restricted to only commercial banks and financial institutions under the guidelines of RBI. They are like promissory notes, but can also be issued in demat form. Their maturity is between 7 days to a year when issued by banks. When issued by other financial institutes, the maturity is between 1 to 3 years. Certificates of deposit are issued at a discount. The return on them is the difference between the said issue price and their higher face price. So it could be on a higher side as well. They are issued only in multiple of 1 lakhs. Okay, so you should remember that they can issued in the multiple of 1 lakhs. They are easily transferable and highly liquid. So these are the instruments of what? Money market. Okay. I hope you have enjoyed this session and you have liked it as well. If you enjoyed it, like, share, and subscribe our YouTube channel. And start preparing yourself because all the banking examinations are on the corner. So till then, thank you. Stay with Entri.